Technical questions during the interview process are becoming more and more common in commercial real estate, and these can be extremely difficult to answer if you don't come in prepared. And while these questions usually aren't intended to trick you, there are a few concepts and key terms you'll want to make sure to go in knowing. So to make sure you're ready in case these questions do come up during the process, in this video we'll walk through a few of the most common technical interview questions I've seen asked over the last few years and how you might want to think through the answers to each. So the first question that I've heard asked a lot over the last few years tests a candidate's knowledge of what drives property values. This often shows up as a question along the lines of, if you have two identical properties, both in the same location, generating the same income, which one of those properties would you pay more for? And typically when this question is asked, interviewers are looking for your understanding of the quality of the income that each property generates and how much certainty you can have that this income will continue. And the first factor to consider, and often what interviewers are looking for most in your answer, is the difference in credit quality between the two buildings, with the property with the stronger credit tenants being valued more highly. Credit quality measures how likely it is that a tenant will pay all of its lease obligations over the entire term of the lease, and the more certainty an investor has that this will be the case, the more they're going to be willing to pay to acquire that property. The term of the lease itself can also be really important here, since assuming credit quality is equal between the two buildings, the longer the lease term, the more income certainty an investor has over a longer period of time, and the higher the property value is typically going to be. And if credit quality and lease term are both identical, another thing that might cause a difference in value is any attractive financing that might be assumable on either property, where the buyer could step in and take on an existing below market interest rate that could also allow them to pay more and still hit their target returns. Other things that could play into value differences could be below market rents at one property that would lead to higher upside for a buyer when leases turn over, or above market expenses at one property that an investor could quickly bring down. But in most cases, when you're asked this question, interviewers are going to be looking most for your understanding of credit quality and the certainty of income that each property will generate. Now, the next type of question you'll want to prepare for is related to real estate product types and what types of properties are most attractive in certain market conditions. A common question here goes something along the lines of, when inflation is high, which types of properties would you want to own? And when this is the case and costs are increasing, property owners will typically want to be able to raise rents as quickly as possible, which makes hotels where rates change daily, self-storage properties where rates often change monthly, and multifamily properties where rates often change yearly the typical go-to product types in these market conditions. Retail, office, and industrial leases, on the other hand, often have lease terms that range from anywhere from between about 5 to 10 years or more, with fixed rent escalation schedules, which means that a property owner can easily fall behind if market rents are rising quickly. Now, one redeeming quality of commercial property types is that unlike hotels, self-storage, and multifamily properties, some commercial leases call for the tenants to reimburse the property owner for their pro rata share of the operating expenses incurred by the property overall, which can be really helpful to smooth out net operating income when prices are rising across the board. Some commercial leases will also have rent escalations that are directly tied to changes in the Consumer Price Index, or CPI, which can be really helpful in an inflationary environment. And on retail leases specifically, you may also see what's referred to as a percentage rent clause, which allows a property owner to participate in a percentage of the overall sales generated by a tenant, which can also be beneficial when prices are going up. In general, the more quickly a property is able to benefit from higher market rents or protect itself from expense increases, the more attractive that property is going to be when inflation is high. And an answer of hotels, self-storage, or multifamily properties are all usually a safe bet if you're asked this question. Now, the last question I want to mention here tests your knowledge of the relationship between interest rates and cap rates and how these things ultimately affect valuations in the market. Because rising interest rates cause borrowing costs to increase, this reduces cash flows available to distribute, which means that investors will typically need to pay less for the same properties to hit their target returns. And when this happens, this means that the NOI of a property ends up being a larger percentage of the overall purchase price that investors are willing to pay. And since cap rates are calculated by dividing the NOI of a property by the purchase price, this results in higher cap rates in general throughout the real estate market. Part of the reason this relationship also tends to exist is because higher interest rates also produce a higher risk-free rate of return in the market, which often leads investors to put their money in safer, more liquid assets that offer similar yields. This is exactly what we saw from 2022 to 2024 as interest rates shot up, and all of a sudden, the interest rate that investors could get in a money market account or even a general savings account was actually higher than the cap rates available on many real estate deals, which drove capital out of the real estate sector overall and caused transaction activity to drop to its lowest level in years. The key thing to know when thinking through your answer here is that when interest rates rise, cap rates also tend to rise, leading to real estate values falling, and when interest rates fall, cap rates also tend to fall, leading to real estate values rising. And this is typically a result of a mixture of increased borrowing costs that reduce investor cash flow and other more attractive investment opportunities that come up in safer, more liquid investment vehicles. Now, it's worth noting that all of these are qualitative questions that require a candidate to apply their knowledge to a sample deal scenario. But if you want to make sure you're prepared for potential mental math questions related to metrics like the IRR, the equity multiple, or the cap rate, I also have another video which I'll link in the description below, which goes over some of the most common mental math questions that come up during the real estate interview process and how to answer each. It's also important to note that even though I have seen more technical questions like these being asked of candidates over the last few years, these are still relatively rare overall, and in the vast majority of cases, commercial real estate firms will rely almost exclusively on an Excel modeling exam to test a candidate's technical knowledge. This is why it's so important to go into this process having a strong understanding of Excel and real estate finance in general. And if you want to make sure you're ready for the commercial real estate job search, along with a potential Excel modeling case study that might be given to you when interviewing for roles, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on commercial real estate interview questions, make sure to hit the like button to let me know, and let me know in the comments if you've been asked any of these questions during the interview process, or if any other technical questions have come up that I didn't cover in this video. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.